Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 264 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. And there's definitely a lot to talk about this week, Matt.
Tons to talk about.
Man,
I have a feeling this podcast is going to be popular, this episode.
Yeah, it's obviously been a crappy couple of weeks here in the market, and it's never fun to go through these type of things. So, most of this podcast is going to be dedicated to kind of talking through what's going on, why it's happening, when can we expect for it to be over, and a couple other tidbits for people to be mindful of.
Love it.
As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts, and as of the market close on August 7th. S&P 500 index down 5.8% for the month and up 9% for the year. The Dow Jones Industrial Average down 5.1% for the month and up 2.8% for the year. The Nasdaq Composite Index down 8% for the month, up 7.9% for the year. The Russell 2000 Small Cap Index down 9.8% for the month and up only 0.6% for the year. The Vanguard All World ex-United States ETF down 5.3% for the month and up 1.5% for the year. 3-month Treasury rate at 5.34%, the 2-year Treasury rate at 4%, the 10-year Treasury rate at 3.96%. So it's not even really just in the equity markets, Matt. If investors wanted to hide out in treasuries, rates have come in significantly just even a month or two ago, right?
Absolutely have.
Which means obviously bond prices have rallied. But yeah, hasn't been much of a fun couple of weeks here, especially over the past week. Moving on to headlines and current events from the week, just wanted to reiterate that the market sell-off has continued and kind of been attributed to the following different areas. Unemployment rate is at a multi-year high. The jobless claims number is at a multi-year high. Credit card delinquencies at multi-year highs. And general inflation and wage inflation is at multi-year lows. And with all this information that the Fed had last week, they decided not to cut interest rates. I think that's definitely the elephant in the room, is that now people are worried that the Fed in September at their next meeting is going to cut by 50 basis points or 0.5% instead of 0.25%.
Yep.
Which, as you've talked about earlier this year on the podcast, the more aggressively the Fed cuts rates, the larger the chance of a declining stock market, right?
Correct.
And that's not what we wanted to see. Also, unemployment is negatively correlated with stocks. It's pretty clear if you look on a chart that, if the employment rate is going up, stocks are usually experiencing weakness. And the unemployment rate has been going up for a few months now. So that's something that we definitely want to watch. People have probably heard that Japan has something to do with this sell-off. And last week, the Japanese central bank raised interest rates in a massive shock to investors. And, just how big of a shock was it? Over last Friday and this Monday, the Nikkei, their main stock market index, was down almost 17.5% over a 2-day span, which was the largest pullback on last Friday outside of 1987 crash on Black Monday, right? So and again, I don't want to steal your thunder, but with seemingly not a whole lot of news behind that, right? Yeah. And a lot of people are, again, attributing this crash in Japan to the unwind of the yen carry trade. So what is a carry trade, right?
Yep.
So I just want to take a few minutes and just kind of break this down for people because it can be kind of confusing.
Sure.
So when the Japanese central bank raised interest rates last week, the Japanese yen strengthened significantly against the U.S. dollar. And for, the past several years when Japan had ultra low interest rates, virtually 0%, investors were borrowing Japanese yen and then converting that to US dollars and using that money to buy US stocks, bonds, treasury bills, you name it.
Yep.
And the key to the carry trade is earning the difference between the low borrowing costs in Japan and the higher return in the invested assets with US dollars. Okay?
Yep.
Follow me so far?
Yep.
So the difference is known as the carry. And the success of this trade also depends on currency exchange rates. And if the yen significantly appreciates against the US dollar, the cost of repaying that loan in yen goes up, right? Becomes more expensive.
And can go up a lot quick.
Correct.
Yeah.
So now that rates have risen, these people that were performing these carry trades have to pay a higher interest rate for the yen that they borrowed. And this is causing a huge unwind of these positions. So
If there's not enough collateral for the loan,
traders are facing big losses and margin calls and et cetera, et cetera.
There you go.
So it just kind of is this domino effect, right?
Yep.
So people are saying, hey, there's several $1 billion in this carry trade right now, and this is why the U.S. market is selling off, because these people are selling their U.S. assets to repay these loans.
especially first thing Monday morning.
Correct. So this has theoretically led to a lot of selling pressure on U.S. equities. So kind of a bunch of different things. I think, there are people out there that are concerned about the geopolitical environment, especially with the rest of the world getting pulled into unnecessary wars going on right now.
Sure.
So the big one, obviously, in Israel, and what Iran's response is going to be, is they had previewed, I think, over the weekend that their next response was going to be great and the whole world was going to see it. So that caused some jitters as well. So there's just kind of a lot going on right now.
Sure.
And I think it's making investors a little nervous.
I definitely have a piece on this coming up. The thing that I always tend to see is not only clients making comments along this regard, but also what you see in the media is, uncertainty's never been like this before. Okay. And I can say from experience, there have been a multitude of situations throughout my professional career where I can explicitly say, yes, uncertainty has been drastically greater than where it has stood over the past month. I would argue, in comparison to many periods, this is a walk in the park. Mm-hmm. And so with that being said, a normal market is all relative. And I think you're going to see my comments in regards to how the market has reacted over the past 3 or 4 weeks, I think is an overblown reaction. Could things get to the point where this price action is justified? Could there be a further deterioration in economic data or geopolitical situations that might justify it? The answer is always yes to that. But we have to get used to the fact that two things: the market sells first and asks questions later, and that's when you tend to see those recoveries. And secondly, the market is moving a lot quicker than it used to in the past. And there's a lot of reasons for that, and I'll be talking about that later in the podcast.
Yeah, no, it was great. I things definitely do move quicker today than they did even 5 years ago or 10 years ago.
Absolutely agree with that statement, Mark. Absolutely agree.
And that's why we've seen this, kind of this relentless selling with not many bounces right to the upside.
Until recently.
Until recently.
And I'd argue, Mark, the important point there is I feel investors have to get used to that going forward.
Yeah.
I think investors have to get used to the fact that corrections are normal. We got spoiled from November, let's just say up until the end of June. I know we had a correction in April, but it was short-lived. I just think we have to get back to the fact that in an uptrend, corrections are normal, and that's just a fact of investing. That's why if there was not this type of volatility, you wouldn't get these types of longer term rates of return.
Yeah, and it'll lead me right into my first point. But the last comment I want to make was just to touch on the uncertainty that you were talking about. markets are always uncertain, right? Now,
Yeah.
there's different magnitudes of that, right? So
Yeah.
I'm sure, back in 2007, 2008 was, probably the most uncertain that you could get in markets.
I would agree with the sustainability of the financial system was at risk.
Yeah. So, there's always going to be uncertainty at different magnitudes, but that's part of this game. That's part of investing.
Yeah.
Right? But leading into my first point,
that tee you up perfectly?
It does. It does. So my first thing was a tweet from Ryan Dietrich on August 2nd. And he said, officially the second 5% mild correction of 24 for the S&P 500. The average year tends to see more than 3 a year.
There you go.
So, again, at this point, like we talked about earlier, this is a normal correction, a normal sell-off within a larger uptrend. Usually there's more than 3% dips per year, and we're not even anywhere close to that. There's usually at least 10% correction per year.
Correct, sir.
And leading up until this point, volatility was super low, and the biggest pullback we had was like 4%. So again, not saying it can't turn into something larger, but this is really the first one step back that we've had this year, where that's expected, several times per year. Right?
Normal.
Right. Next thing I had, again, was a tweet from Ryan Dietrich. This was on August 6th. He says, the S&P 500 down at least 1% on a Thursday, Friday, and Monday, like it was last week and the beginning of this week.
Okay.
Pretty strong returns across the board. 3 months later, higher 90% of the time and up nearly 10% on average. A year later, up 18 of 21 times and up 22.5% on average. Good chance those times felt pretty bad also.
This goes back to what I said a week ago. When you get your opportunity to buy the dip, you're not going to want to.
Right.
And once it recovers and feels safe, your opportunity's passed.
Right. And that's just human emotion, right?
Absolutely.
We feel that too. It's like, oh, this doesn't seem too fun to buy, at these prices.
Sure.
Because there's always that chance in the back of your mind that the market's going to drop another 10% or another 15%.
Which is always possible.
But I think, Ryan and his team have done a good job keeping the focus on the data relative to news headlines, which I know that we put a lot of value on and put a lot of emphasis on for our clients, is let's look and see what the data says. Let's not look and see what CNN or Fox News or MSNBC says what's going on right now.
Absolutely.
So again, long term, things are looking pretty good. The longer and longer you go out, I'm not trying to minimize how bad this might feel to a lot of people right now.
Well said.
But that's why we try to keep this long-term investing lens, out in front of us.
Well said.
So next thing I had was a tweet by Charlie Bilello in reference to Japan on August 5th. So he says the Nikkei's 12.4% decline today was the second largest in its history, trailing only the 14.9% fall during the October 1987 crash. What happened in the year after the 1987 crash? The Nikkei 225 rose 26.5%. Those who embraced panic were rewarded. So again, kind of similar to my previous piece, if you can get through looking past today, tomorrow, the next week, the next month, the next half a year, 1 year out, these tend to be pretty good buying opportunities.
Which, if you really think about the average investor's time horizon and goals and objectives, most investors don't have money in the market that they need a month from now, that they need even 6 months from now.
And if you do, I would argue that's a mistake.
There you go, right? And I think sometimes looking at the basics in circumstances like this make a lot of sense. And that's a basic that a lot of people forget. Yes, as you said a couple seconds ago, is it unsettling to see the market value in your portfolio drop? Absolutely. But we have to be mindful of the fact that most investors with proper time horizons don't necessarily need that money next week. You and I have no idea what the market's going to do next week or the week after. But longer term, with the data on our side, most likely the market's going to be higher over time.
Yeah.
And the market has proven to be a reliable source of producing returns.
Correct.
So I just think sometimes looking at the basics is very important in light of the fear-driven headlines.
Yeah, and this is 1987 is not the only example, and we're talking about Japan here, so let me just preface that. But,
Sure.
in 1953, it was down 10% in a day. 1 year change going forward was positive, only by 2.6%, but it was positive. 2011, market was down 10.5% in 1 day. The next year, 1 year return was almost 18%.
Yes.
2008, obviously a big one. Market was down 9.6% in a day. 1 year forward, up 28%. So, it's not like we haven't seen this before, right? And I think this is good to...
And we'll see it again.
We'll see it again. So, again, for those longer term investors, this might be one of the best, might be going forward, your chances to get in at lower prices, especially with, the way technology has pulled back and the way us and several others see the technology landscape evolving over the next several years.
Absolutely.
So, last thing I had, Matt, was a LinkedIn post from Campbell Harvey on the Fed and recession indicators. So Campbell is a professor at Duke University. Been following his work for several years now, and he really specializes in recession indicators and specifically using the yield curve to predict those recessions.
Okay.
So this is going to be my one bearish piece that I have here, because we like to look at markets through bullish and bearish lenses to see what the potential outcomes are. So I just wanted to read a couple of the points that he made in this post. So he says, "We have seen this movie before. The Fed was very late to take inflation seriously in 2021. It seemed obvious that inflation was surging. Real-time shelter inflation was increasing at a double-digit rate. Shelter has the largest weight in the CPI. Shelter operates with a lag, as we talked about on this podcast before. Hence, it was easy to forecast the surge. The Fed was forced to react after the damage was done. The same mistake has been repeated. The recent CPI print was 3% year over year. Nearly 2/3 of this print was driven by one component: shelter. Shelter
inflation. Talked about this in the podcast.
Shelter inflation is reported at 5.2% year over year. This number is far from reality. Apartmentlist.com rents are running, according to Apartmentlist.com, rents are running at negative 0.8% year over year, a full 6% below the official CPI number. Suppose we believe the real-time shelter inflation is 2%, not 5.2%. This means the real-time CPI would be 1.8%. And if you believe shelter is even at 3%, then the real-time CPI would be 2.2%. These numbers are well within the Fed's target. The yield curve indicator has been inverted for 20 months. It's 8 of 8 with no false signals since the 1960s, and he means predicting a recession. The maximum historic lead time before a recession hit has been 23 months. Now the Fed will have to play catch up and cut by at least 50 bips in September." So, just looking at the other side of this, that we could not be too far off from a recession. I know that there's I'm not going to be the person that says this time is different, but there's obviously different factors and circumstances going on right now. But he might be right. So and I think before I turn it over to you, it is also important to point the caveat out that not all recessions are the same, and not all recessions look like 07, 08.
Yeah, and the problem is that's always associated in that fashion, right?
Right, because it's the most recent.
That's right. That's right. Well, here, I'm going to transition, and I'm going to kind of title this kind of my raw thoughts on the market, okay? So the first thing I want to talk about is media companies. So we got to be mindful that media companies make more money in advertising when eyeballs are focused on them. We got to talk about the fundamentals. What's our motivation professionally, Mark? We manage money for clients, and we get paid an asset under management fee. We are incentivized to grow and protect our clients' money. That's our motivation, right? Media companies, they make more money when people are watching. So in the most recent week, this was a headline on a major financial network. The headline that was being talked about is, quote, in regards to the Nasdaq, "We've never been down 1,000 points ever on the Nasdaq." Okay? So let's talk about this. That equates to the Nasdaq at this specific point being down 6.29% intraday. I don't want to overplay this because this gets me really worked up, but there has been a lot of times where the Nasdaq has been down more than 6.29%. So we got to remember, the points don't matter with the indices. The percentages do, okay? The other factor that's at play with this is client portfolios. There's a lot of clients that have seen a big rise in their portfolios, especially over the last decade, even despite the correction in 2022. And when the market corrects 10%, I'm going to use simple math, Mark. If your portfolio a decade ago was $500,000, we had a 10% move, in dollar amounts, that was $50,000. Now that your portfolio, let's just say hypothetically, is $1 million, and we go down by 10%, that's $100,000. So what you tend to see is clients focusing on the dollar change, not the percentage change.
Right.
And you now have the media doing the same.
Right.
So I want to just highlight that. It is worthy to talk about. Before I go to my next point, anything you'd like to add?
No, and I think this was expected any time that the market goes through a tizzy is, this type of treatment from the media. And I don't want to be one of those people that harps on how bad, the media is, but it's just, this isn't doing anyone any good.
Yeah. I mean, I'd argue the Dow Jones Industrial Average no longer be a relevant index if it wasn't sensationalized on the point number.
Yeah, correct.
All right. My next point, and we alluded to it a little bit ago, but I think it's due for a deeper conversation, is I do think investors in general need to be prepared that going forward with how quick information moves, with computer-driven trading, moves are going to be quicker. So I want to have Jenna put up a chart. This chart is going to be from Charlie Bolello that shows the VIX, which is the volatility index. For our newer listeners, the VIX is in essence a fear gauge. And it is a gauge that looks behind the scenes at derivatives to the degree that people are being offensive or defensive. But to make it very simplistic, when this index goes up in value, the degree of fear is rising dramatically, okay? And usually this index is sitting somewhere in the teens. 15 to 20 seems to be a historical average. Anything above 20, you're starting to initiate fear in the market. Well, when we look at this chart, this will be in our show notes. This chart will go back to the early 90s mark. You have two periods where this index really spiked, okay? In 2008, in October of 2008, when the actual legitimacy and soundness of the financial system was being questioned, it got as high as almost 81, okay? And then right when the pandemic hit with the uncertainty worldwide, when we had the market literally moving up and down 10% a day for a couple of weeks, that was in March of 2020, the index hit 82. This past week, Monday morning, we got up to 65. And when you look at this chart, you would assume something significant was happening, okay? And this goes back to my opening comments to where we need to get prepared that some of these moves are going to be done in a consolidated fashion, and they're going to get exacerbated. And I'd argue on both sides, not just to the downside. So my point here is going forward, computer-driven trading, leverage in the system, a lot of this is going to make these moves quicker going forward. And unfortunately, it's something that us as investors have to get used to. Before I go to my next topic, anything you'd like to say?
No, I don't disagree. Again, most of the time, volatility is not this high, but when it is, there are significant moves in the market. And I think it just goes back to what we were talking about earlier, where, this is the price volatility is the price that we pay to get these longer term rates of return. And
That's why having your investment time horizon proper is an important topic.
right. And I think it was a really good point that you made, several years ago. A 10% move wasn't as big of a dollar value for some people, but now fast forward to today with all the market growth over the past decade or the past 2 decades, when your portfolio is moving by $100,000 or hundreds of thousands of dollars because it's grown so much, it's jarring, right?
Absolutely.
But that's why you do have to look at it from a percent standpoint.
And that's why you got to that level to begin with.
Correct.
All right, a couple more points. Lots of calls in the Fed to cut interest rates in between meetings. So let's just take 60 seconds and step back. For our newer listeners to the podcast, the Fed meets every 6 weeks. They meet every 6 weeks on a consistent basis to report to the public their views on monetary policy and any changes that come forth with that. The next meeting officially for the Fed is the middle of September. Last time they met was just literally, as you said, about a week ago.
Yep, September 18th, to be exact.
So here's my thoughts on this. I personally don't feel the data supports an emergency cut in between these meetings. Could they do a 50-point cut coming up in September, and is that warranted? We could have a roundtable about that, and probably so. But I think if they do an emergency cut, I think, unfortunately, that sends a message to the market that they're very concerned about the economy. Hence, investors should be concerned about the market and the economy. I think the best thing the Fed can do is wait to do its cuts during a regular meeting. Your thoughts and comments?
I would agree. I think that a aggressive 50 bip cut would be emergency cut, not waiting until September, would spook the markets even more. Because that would, I think, be the Fed admitting, whether good or bad, hey, hand up, we messed up, we should have cut in July or August, whatever last Wednesday was.
Agreed.
Right? So I think that would spook people more. The other point I want to make here too is we talked about everything that's going on that could cause, the market weakness right now. The one thing that I don't think people are talking about enough is this sell-off is not based on the fundamentals of publicly traded companies.
Ooh, keep going.
So if you look at the 20 largest companies in the S&P 500. I'm talking your
market cap.
Your Apples, your Amazons, your Facebooks, your Googles, right? Mm-hmm. Their earnings are fine. This isn't a earnings or revenue related problem to publicly traded companies. These are factors outside of that. And I think we'd be having a different conversation if it was related to company earnings and the financial viability of some of the largest companies in the world, but that's not what this is.
I couldn't have said it better. Couldn't have said it better. So my last point, and it may be along that same wavelength, Mark, is talking about the economic data, because that's the primary narrative you heard in the headline the last couple of weeks. So this is my unfiltered and direct, transparent thoughts on this. I'm not seeing the data bad enough to make the case that we're in a recession now or will be soon. The data can, of course, change, but I don't see it yet. I've been vocal about concerns with clients and on this podcast, things such as full-time employment data. That's not a recent topic for me. I've been talking about that for several months. Consumers' balance sheet and sentiment, where the trajectory of that's going. You can continue to see job losses. It's eventually going to affect consumer psyche, right? Corporate earnings growth is continuing. Upcoming election season, geopolitical uncertainties. I think investors should continue to focus, and this is the most important thing, should focus on the most likely outcome, which is this, in my opinion. We're not in a recession currently. Will a recession happen again? Absolutely. The question is, how fast? The market has made the assumption over the past couple of weeks that that is now. Historically, when the market acts like this, it tends to have a nice counter rally. How long any sort of rally lasts with the proximity of the presidential election season is anyone's guess. But that's my base case, my personal opinion. Your thoughts?
Yeah, I don't disagree. I think a lot of it, unfortunately, is going to hinge on what the Fed does, which I don't necessarily love. But
good point.
Now they're kind of pigeonholed into this position where, I would ideally, even if the economy needed a 50 bip rate cut just for confidence, I would rather them do a 25 bip rate cut, 0.25%.
I would agree with you. And if they sat there and said, hey, we're going to do 25s and we're going to do them consistently the next couple of meetings and reevaluate the data, I mean, let's face it, GDP is nowhere at the current point going negative. And I'm old school with my definition of a recession. And I've been vocal about that in the podcast before. So recessions are very easy. 2 consecutive quarters of negative GDP growth. Put all the political biasy that they add to it,
which we had
in 2022, the first half of the year.
Right. So that's the other thing about this, right? Is that, technically there was no declared recession in 2022.
But there was.
But yes, there was. And, people aren't counting that as an official recession. So people.
But if they did,
then all of the data that I just went through with the yield curve and what Dr. Campbell Harvey talked about
will be very much augmented.
It would be very different because we already had that recession. So it's going to be, again, and I hate this uncertainty as much as anyone else, but it's going to be very interesting to see what happens, because I think on the flip side of it, in let's say 10 years from now, they look back and they're like, oh yeah, actually
that was a recession.
2022 was a recession. What happens if we don't go into a recession over the next 2 years? Are people prepared for that? I feel like everyone is prepared for the worst of the worst right now, but are you prepared for good times rolling on if we don't go into a recession?
Well said. I mean, I'm gonna do a Mark McEvely classic quote. It's what the market is not focused on is what derails it, is what takes it by surprise. So Jenna's going to love that. I'm taking a Mark McEvely classic quote. And if everyone is concerned about an imminent recession and it doesn't happen, what happens to the market? You're going to see a pretty big counter rally, right?
Yeah. And
that's a possibility hardly no one's talking about.
No. It's all doom and gloom. And it's usually doom and gloom, but even more so in times like these.
Sure.
You're like, oh, it's done. We're over. Everyone's going broke. The world's going to hell in a handbasket. We have an election coming up. It's gonna ruin the whole world.
Yeah. And then you see corporate profits continuing to chug along nicely.
Yeah.
All right.
And the other thing, but not to interrupt you,
Please.
is that's been really big over the past weekend was that Buffett reduced his Apple position. So everyone thinks that Apple is done for, put a knife in them type of thing, and
or overall he's really bearish on the market.
Right, and Apple is still his largest position by a lot. So I just want to keep that in people's eyes. Is the only headline you're seeing is Buffett significantly reduces Apple position. The other one is it's still a huge position for him.
Absolutely. And we could have a podcast just within itself about the speculation as to what Berkshire Hathaway is going to do with their $277 billion of cash in the balance sheet.
Right.
There's a lot of speculation. It's going to be a big purchase of an entity he needed to raise cash for. Was it a diversifier? There could be lots of reasons. Right. So let's take a turn, and I know we always like kind of quoting the data. These quick spikes in the volatility index are not common. So when they occur, it is nice to look through the lens of history. Seth Golden had a really good post about this, Mark, on August 5th, and he highlighted, when you have these 3-week periods to where volatility spikes to this magnitude, okay? The forward-looking rates of return, when you kind of look at the data, and there's about over a baker's dozen. But the point I want to make is 1 year forward, when you see these types of quick moves higher in the volatility index, the average looking forward is almost 17.5%. 2 years later, cumulative return 34, 3-year 51. The data goes out farther. I'm not going to quote it, but kind of as you've alluded to, not necessarily bearish or spelling immediate doom. There are some data sets such as 2021 during the pandemic in 2008 where the forward return was actually negative. So it's not guaranteed, but it is something to note.
Yeah, and I think the best way to say it is certainty gets far greater the further and further you go out on the time horizon. I can't tell you what's going to happen next week. I can't tell you what's going to happen in the next 3 months.
Well said.
But what I can tell you is over the next couple of years, chances are the market's going to be higher.
Well said.
Right.
Well said. Last thing I want to bring up, because this is always something that I pay attention to during these times of weakness, is something called a margin call. And what a lot of our listeners and viewers might not understand is there's a lot of investment vehicles, one way or another, that borrow money and use leverage for their investments. You talked about the yen carry trade at the top of the podcast. Well, there was a quote that was placed on X by Walter Deemer. He is a retired trader, and he was quoting someone else on Wall Street. And the quote was, quote, "Margin clerks are the most ruthless sellers Wall Street has ever known," end quote. And the reason this is out there is when you have mornings like Monday, there are these margin desks at all these major custodians, Fidelity, Schwab, all the wirehouses on Wall Street. And if you are taking loans against your portfolio and the value of the underlying securities drop tremendously, you either need to pretty much immediately deposit more money or they're going to start liquidating. And you, the account holder, the portfolio manager, you have no say to what they sell. And they're ruthless. And that's what causes a lot of those downdrafts really bad, either at a market close or a market open like you saw on Monday. And so I just want to kind of throw that out there because what was followed by this is what Walter said. He goes, when margin clerks are told to sell, they sell immediately at any price they can get. That's why so many bottoms are accompanied by some sort of forced selling. Makes sense.
Yeah, and people use margin in the first place, i.e. taking loans to enhance or magnify returns.
Sure.
Well, it also doesn't just
magnify the upside.
It magnifies the downside as well.
Yeah.
So, and again, somewhat of that kind of what's going on in Japan right now is that people are selling things so they can pay back these loans.
Yeah,
it's great for certain people. I mean, for the average person, I think it's just not necessary because you get into situations.
I would not recommend
like
it at all for the average investor.
Yeah.
I think coming to a close for the podcast today, I would categorize this as a classic, TED Talk / masterclass on market volatility, right? And I think this will go down as one of those podcasts that, when you see further events in volatility, the things we talked about today can easily be referenced in the next 10% plus correction. And ultimately, at the end of the day, you need to be investing for your goals, your objectives, and more importantly, your time horizon. Yeah. So I think that is a very well put together podcast on both of our ends. So great job, Mark.
Yeah, I think it was good. Hopefully people got a lot out of this, and hopefully we made sense of at least of what somewhat is going on.
Sure.
Again, turning on the news and watching the fear-mongering headlines is not going to do anything else other than add stress.
Correct.
It's not going to make things better, so why add that additional stress to your life?
That's right. And sometimes not taking action or actually buying on the weakness is the better move.
It's the hardest thing to do, but a lot of times it's the right move. I think
Correct.
that was a Buffett quote, too. So those people that are bearish on Apple and want to follow Buffett, sometimes you just got to sit on your hands.
So it's tough to do sometimes.
Lastly, if you want to create your own podcast, use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code JessupWealth, all lowercase, no spaces. If you're looking for an AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. Use the link in the show notes below to purchase your subscription and make life a bit easier. That's all for today, and we want to thank everyone again for listening to episode number 264. We will be back with you on 265.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.